Now, on to market movers with easy to follow futures and options trades from CME Group.
Welcome to Market Movers. I'm Jim Iuorio, and today we're taking a step back and we're going to take a broad look at one of the most traditional risk-off assets, and that's gold. And gold's been in somewhat of a steady downtrend for the last few months. We're looking at using longer-term options to either hedge risk or create exposure to gold prices going forward. Now, joining me is Chief Investment Officer of Kingsway Asset Management, Scott Martin.
Hi, Jim.
Okay, so gold is going down. Why is it going down? Could it just give me the absolute answer?
Because it's got lower prices baked into it. Here's a lot of things that are going on. I think the introduction of maybe some of the cryptos have taken the eye off the ball. I believe maybe more stable economic data globally has probably made things a little bit less scary out there for the average investor and trader. And just the fact, too, that the U.S. dollar has risen quite a bit this year, which has pushed pressure on other
brings me to my
commodities.
second question. Do you ever see a scenario where gold and the dollar move together?
Potentially, but I think it would have to be a pretty big risk-off event in the sense where you have something happen geopolitically, something happen economically that's very, very dire and out of left field.
I agree, and I believe that's happened in the past, too. Now, before we're going to dive into our trade discussions, I'd like to point out, with all market movers, it's important to view these as examples that allow you to see different ways to use futures and options products to either manage risk or create additional trade opportunities, not as recommendations or advice. Prices and movements will vary in the market. Scott?
Yeah, gold. I mean, if you even look at the chart, Jim, I mean, which I like to do, I really like to start my expressions with looking at the chart and just seeing if the chart tells me something first and foremost. And if you look at the chart of GC over the last year, 3 years, 4 years, 5 years, doesn't look great, does it at all?
No.
So, but it looks like just there's some rounding out that maybe is going on to where things have gotten overdone to the downside. So specifically today, Jim, looking at buying the November gold 1240, 1260 call spread for about 5.4 ticks. This trade expires on October 25th as it has the November underlying. It costs you about $540 to put on and make a potential $1460 if it fills out, because of the fact that it just looks like this downtrend is getting worn out, and the belief that maybe things have been a little bit too good lately. Maybe things have been a little bit too rosy. It looks like maybe the dollar is topping out. I'll be quiet in a second. So I think that the best exposure here is to maybe try to get some upside here in the GC.
And I like it. You mentioned a long-term chart. When I was looking at the 5-year chart, that 1200 level is a spot of some significant support. Now, what's interesting is we looked at it the same way. We came to the same conclusion, but we're going to express it in different ways. I'm looking at buying the November gold, the 1220, 1240 call spread for 8.2 ticks. The trade expires October 25th and has the December underlying. It risks 820 and make 1180. Now the difference is, and I pay a higher price, but mine's
closer,
more likely. It's closer. It's 20 ticks more.
Sure.
So you can get, when you look at the two together, one costs 8.2, one costs 5.4, and that's what the market's telling you the likelihood that they fill out. Do you like it?
I do like it. I think the exposure is correct, and I do believe that with anything, when you're pricing out trades and looking at different levels, whether it's the chart that's telling you different levels or whether you're just exposing yourself depending on different levels as how far out you want to go, looking at those differences in pricing is very important, because sometimes the risk reward can vary, as it does in this case.
Okay, now both of us gave bullish trades. Both of us are relatively short term, a few months. Longer term, 1 year out, 2 years out, 3 years out, is gold still going to be on the list of risk-off assets that we run to?
I believe it will be, but as we've seen over the last couple of years, the profile of gold, Jim, has changed so much given the introduction of other asset classes and so forth.
No doubt.
There's no guarantee of that.
Interesting. Thanks for joining us on Market Movers. I'm Jim Iuorio, where we're helping to make you a better trader.
Check out businessfirstam.com to find out where to see our entire show. And don't forget to like, follow, and share Business First AM.